Okay, welcome. Welcome to the webinar entitled Managing Risk in 2020. Thank you for joining us. We've had quite a few people have gotten registered. So I want to make sure that we get you started on time. And as promised, this is going to be a little under an hour. And what we're going to be talking about is just some basic ideas for how you can manage some of the risk, especially with the uniqueness of this year. Some of you, welcome. You were invited by clients of ours who have already developed what we call their financial GPS. And all that is simply the process that we help people with to make sure that they get to the retirement that they desire, which is, something that's a challenge for a lot of people. But that's simply where we talk not only about the finances, but also about Social Security, about the legal documentation that they need to have in place, and anything that can affect them during the retirement lives. So we're going to talk about a few conceptual things. We're not going to get overly technical in any of the information that I'm going to share with you today. I'm going to throw a few ideas in there. Hopefully you've got something to write down with. Some of you were invited just, as I said, by some friends of ours or clients, maybe from family members or coworkers. And some of you just have reached out to us because a lot of our clients have said, I've got friends that need the same safety types of plans that we have, and we want you to do another class or something for them. So for the time being, we're not able to do the classes just because of everything that's going on. So we hope that you'll enjoy this presentation. Also share it with friends as well. We will have it recorded so you can get it later in the end, and we'll be glad to share it with others. Again, our mission is just to help people with a lot of these challenges that they have with their finances. We will also have an opportunity for questions at the end. So while you can't, your phones are muted, just do me a favor. If you've got questions, write them down or type those in, and then we'll be trying to answer them if time allows at the end. But if for any reason we can't get to your specific questions, then please email us and we will answer those for you as much as possible. So we're going to talk about a few things, and just real quickly to go over those about the virus and what effect that's had on the economy and continues to have on the economy, about market volatility. And all the word volatility means is risk. So market risk, we're going to talk about that because that's a big concern. We're also going to be talking about what we call a portfolio stress test, because that's important you understand what that is. Bond replacements, what that means is there's a lot of people that are looking for what bonds used to be able to provide, which was income. But there's a lot of changes with that also. And then also retirement income, about a more predictable, sustainable retirement income that's predictable. The number one challenge that most of the people that we speak to when they come in and meet with us or we're talking with them for the first time, their biggest concern is, will they have enough? Meaning, will they have enough to retire? So again, this isn't going to get overly technical. That's the number one question that we help people understand. A lot of times they've been working either with an advisor or on their own, and they haven't built what we call an income plan. So about 77% of people don't even have an income plan. They're only working to accumulate money. And here's the reality. You've got to have a plan, one that is predictable and sustainable, so that in retirement you have the income coming in that you want, that allows you to have the freedom that every day when you wake up, you realize, I don't need to go to work, that my money's working for me. So hopefully that makes sense to you, because again, this is not about taking high risk or anything of that nature, but it's about having what we call sleep insurance, if you will. So you sleep really good at night, no matter what's going on in the chaos in the news or anything else, because those things are going to constantly happen. So we like to make sure we put a plan where you're in control of your money instead of your money controlling your life. So with that, let me jump into some of the materials, and I want to make sure that, again, I cover this with more than enough information for you. You can see our visual there, and that's really one of the things that we use, a lot of visuals. And in this visual, you see, hey, the market dropped a lot. Well, it didn't just drop a couple of months ago. It dropped a lot back in 2008. It dropped in 2000. And so these are things that normally occur anywhere from every 6 to 8 years or so. And that's just the reality of life. It's kind of like if you live here in South Florida, and I've lived here most of my life, we know that we have hurricane season. And so what do we do for that? Well, hopefully we have hurricane shutters or maybe impact doors and windows because we know it's going to happen. And that's the same thing that I try to stress to people is, look, this is going to happen. And if you've got a plan in place to make sure that you're going to be okay when these things occur, because they're going to, then you're fine. So the only thing that we do and we build are defensive plans. And that really brings a lot of comfort for the people that we work with. And as we go through some of these different slides, again, there's some technical parts that are in there, but we want to make sure that we keep this very, very simple and understandable so that you get something out of this. So a little bit about my background, so you need to just know who I am if you were sent this by friends or family members. I spent the first few years of my adulthood, if you will, as a United States Marine, and I'm very proud of that. And the reason why I went in the Marine Corps is I loved challenges, and it was an environment that just absolutely gave me constant challenges. I was working with a group of professionals that we were always headed in one direction. We all had a team uniformity, but we were also very passionate about what we were doing. If you know any Marines, that's just the way that we are. It's something that's inbred in us in boot camp. So after I got out of the Marine Corps, I was looking for something that also equally challenged. And finances are a big, big challenge that daunts most people. So I take a lot of pride in helping protect people with their financial plans. The same way that when I was in uniform, I was helping protect the nation, then this is what we do with our clients and their own financial plans. So I'm very passionate about what we do. I've had some people say to me, wow, you run this like a military organization. And I take that as a compliment because these are critical things, just like in the military, but your finances are critical too. And it's something that we try to tell people, don't take them lightly. So, you know, the other thing I share with people is that we're a fiduciary. And here's all that means. We have to always have your best interest at heart. Before we even think about doing anything else that maybe provides some income to our firm, it has to be what's in your best interest at all times. So that isn't the case with all advisors. And if we really believe that that's critical, it's kind of like when you go see your doctor. They have that same fiduciary responsibility that they must always do what's in your best interest. But we're also holistic, meaning we don't just look at your finances. We do planning for people for Social Security, which that's a big thing in our college classes. We do a lot of college classes as well. We talk about that. That's a very confusing issue for a lot of people about when to file. We also talk to them about getting their legal documents in place, and we help facilitate that. And a lot of other things as well that maybe we don't directly profit from that, but it's what our clients need and what will affect them over their lifetime. So hopefully that makes sense. The biggest thing I try to say to people, and the biggest compliment that we get, is that we get to make all of these things simple for them. We make it simple. I have a lot of clients that when they come in, and we have a big whiteboard that I do most of my illustrating on, and they say to me, I like it that you draw pictures for me because I understand them. Well, we want you to understand. It is technical on our end. I mean, that's obviously a lot of the licensing that we have. That's why we're licensed professionals, but we don't start talking about all the algorithms and all these other things that would confuse people. We simply say, okay, where are you? What is it that you want to do? And then we help you get that done. So again, I'm going to keep all of these different areas very, very simple because I want to make sure that you understand and you retain some of these things. So hopefully that makes sense for you. Let me give you a little about why. My why of why I work in this specific area when it comes to retirement planning. You see, this is a picture of my mom and dad and my sister and I a couple years ago during Thanksgiving. And the reason I share this is I talk a lot about the story about my father, who he's still around, always have been my hero. You know, my dad is a man of few words, kind of like the way a lot of us grew up watching John Wayne. John Wayne was always my hero. And my dad is a lot like him, meaning he doesn't sit there and talk a lot. He simply is a man that will tell you what he wants done, and he expects you to get it done. And so his nickname is Grumpy. So if you grew up with a Grumpy in your life or somebody with a nickname like that, you realize that makes you unique, right? But the reason my dad's nickname was Grumpy was because he was in the construction industry, but that's not what he had planned on doing in his life. You see, He was 19. He was going to the University of Miami for architecture. He had a 4-year scholarship because he was very gifted in that. But his first year of college, unfortunately, his father passed away unexpectedly. And so my father did what men do back then. He had to drop out of college and forget about his dream so that he could provide for his mom, who couldn't work, and his brother, who was in high school. And he's never complained about that. He just said, you know, these are the cards that God dealt me. And so he worked and worked and worked, woke up very early, and we thought that my dad would never retire. Well, for the first 13 years in the business, I was handling all of his affairs, and I was also handling it for people of all ages and college planning and tax planning and you name it. But then my dad called me up about 6 months before his 70th birthday, and he said, hey, I want to talk to you about retiring, which was a surprise because my sister and I joked around that he'd probably work till the day he died because he never talked about retiring. And so what he said was, you know, I want to go ahead and retire on my 70th birthday. And he said, but here's the thing. I don't understand all these things that you do. I don't understand the investments that you've got me in. I don't understand the insurance. I don't understand what all these things with Social Security. And I don't want to understand that. He said, all I want to know is when your mom and I retire, we never have to worry about going back to work again. And that was it. And so those were my marching orders, if you will. And so that became, for me, a mission statement because I realized how critical that was. And not that younger people aren't important and some of the other plannings aren't important, but this is critical. You can't make a mistake with this because if you make a mistake, then people end up going back to work at times when they really shouldn't have to. And these are the years that they should say, wow, I worked all these years and I just want to enjoy the fruits of my labor, rather than, if you've seen, unfortunately, sometimes you see someone that their plan didn't work out or they didn't plan well and they have to go back to work. And that's not a good state of affairs. So hopefully that makes sense. So as I talk about these different areas, realize that's all we do. We only work on plans where people are saying, all right, I've already done the work. I want to make sure that things that are outside of my control, health or the market or whatever, they're not going to upset and make me have to go back to work. So hopefully that makes sense to you. Again, try to keep it really simple, but I also want you to understand why we focus on this area. So as a reminder, we've got to tell people, look, you're going to have distractions. If you'll stick with me the next hour, I promise you that I won't look at my phone. If you stick with us, there's going to be a lot of cool things here that you'll grab. And again, I encourage you to write some things down. But just, again, avoid some of those distractions, please. So let's talk about some of the things that have occurred and keep occurring, it seems. A lot of things have changed. And that's probably the understatement of the year. I had a friend say to me the other day, wow, this keeps getting more and more and more every time I turn on the TV. So, you know, one thing that I'd encourage you to is don't sit there and constantly watch all of these things. You do have to stay informed, but these kinds of things are always going to happen. Maybe not to the extreme, but they're always going to happen. And a good friend of mine, after the market first went down due to the virus, called me up and he said, you know, this brings you a lot of credibility. And I looked at him and I smiled and I said, well, you know, tell me about that. What do you mean by that? And he said, well, because you've been speaking for a while that the market was going to go down. And he said, and it did. And I said, oh, okay. Then he followed up and he said, yeah, but to be fair, you didn't know it was going to be a virus. And I looked at him and I said, okay, you're right. But to be fair, back in 2000, I didn't know that it was going to be 9/11 that made the market go down so substantially. And to be fair, I didn't know that it was going to be 2008 that the market was going to go down on housing, and that would make it go down. So here's the thing. I don't need to know what it's going to be because the market just does that for different reasons. But if you build a plan that says no matter what it is that makes the market go down, you're going to be okay, then that's a plan that works. Again, like those hurricane shutters. You know it's going to come. If you don't think the market's ever going to go down, you know, you're not really paying attention because it does. But we want a plan that makes sure that when it goes down, you're going to be okay. I hope that makes sense to you. So in case you've forgotten some of the things that did occur because there's so many, you know, we need to adapt and manage to the reality. But what is a reality? What are some of these things that have caused this new quote unquote financial reality? Well, First, we had a decline. You know, we were on an 11-year bull run. That means the market went up for 11 years. It went up to the highest point it's ever been in our country's history. Now, you can watch all kinds of different news channels and say what made it do that and argue that with different people from both sides of the aisles. But let's just look at it and say, okay, it went up like crazy. But then, of course, what goes up must come down in the market. Then, on top of that, we had a huge amount of people that were unemployed. Why were they unemployed? Because businesses were forced to close. Something that we never knew the terminology before is a now everyday phrase, social distancing. You know, or at least I had never heard of that. Now everybody knows what it is. Well, that means you have to close, everybody stay home, and that means it's going to take longer for people to then get back to work. So that made the market go down. The federal government, you know, they were saying we're here to help, right? Federal government. And they did send out some stimulus checks. They also did some loans to small businesses and such. But the reality of it is somewhere that money is going to have to be paid for somewhere. So not to make that look like a bad thing, but just as a reality of that may mean your taxes might possibly go up later. So you got to look at that. Then again, the COVID-19 meant the stock market plunged and all the gains that people had, well, man, those were wiped out in a short period of time. But it's the largest drop in history because of all of a sudden, think about it, on 9/11, at least we all didn't have to just stay home. So we were able to go out and still see things and do things, but the COVID meant we couldn't. So that's one of the reasons why the drop was so huge. So some of the different changes are, number one, the stock market risk has increased. Again, volatility just means risk. Stock market risk has increased dramatically. The Federal Reserve, they slashed rates, meaning the lower the Federal Reserve go on their rates, their hope is people will start using more money and taking loans. But what that meant was bonds where people were getting some income, those values really dropped. And that's why people are asking us for what are some alternatives to bonds. And then, you know, cash is safe, right? But you can't take your money and bury it out in the backyard. You can, but it's not going to do much for you. And you've got to know then when are you going to get in the market, out of the market and such. And that, unfortunately, has not really helped people where they've tried to time the market. So those are some of the things that we look at with the current occurrences that are going on. So here's that wonderful market ride we were on for 11 years. From 2008 to 2011, I'm sorry, for the next 11 years, in March of this year, the market just took off like crazy. And anybody that's in the industry knew that it was an all-time high. I mean, you heard that. And here's how you have to think about it. You have to think about it like you've got a house that's in your neighborhood that is so high priced as compared to what the other houses around are, that it just doesn't make sense of why is the value so high? And we saw that happen with real estate on our own, you know, between 2000 and 2007. We saw that. But then all of a sudden what happened is between mid-February to mid-March, we lost 33% in the market. 33%. I mean, all the gains we had, gone. For people that were getting ready to retire and their 401ks went down 33%, think about how long that took to make that money and put it away. And that's what hurts, is the market is up, and yes, it goes up, but these staggering losses that can happen, this is less than a month that this happened. Think about that. A huge, huge loss. And so that's one of the things that we talk about is, okay, the market's going to go up and it's going to go down. In fact, let's look at historically some of the what's called market indexes. And again, I don't want to get complicated. So this is what's called the S&P 500 index. So when you go home at night, you hear on the news that the Dow is up or down, right? So let me explain to you what the Dow is. The Dow index is the top 30 companies in the United States. So basically all they do is they put them all together in one index or one account, if you will. And they say, okay, did all 30 companies have a good day or bad day. And then this is the S&P 500 index. And so instead of it being just 30 companies, this is the top 500 companies in the United States. So this is a broader index that basically says that the 500 companies have a good day or a bad day. And this chart itself is on a yearly basis. So what this looks at is, you'll see in the year 1996 down here that the market took off and it went up all the way to the year 1999. It increased, if you'll see here, 106%. And everyone knew at that point that the market was overpriced, that it was just high, that was a tremendous amount of gain in a short period of time. But people were still buying and selling, right? Why? Because, man, they loved getting the great returns. Then all of a sudden, 99, we had Enron and WorldCom, where they found out that these executives really weren't reporting the numbers right. And so then people started worrying about the stocks they were invested in, and 9/11. And those three things meant that they went down 49% from 99 to 2002 on average. And this is for the average investor, right? So then people said, well, the stock market's no good to invest in anymore. What's a good investment? Real estate's a good investment, right? We've always heard that. So people started buying and flipping and buying and flipping and buying real estate, and they've never had real estate before in their life, but all of a sudden they own real estate. And so it was a cool thing to be able to say, oh, I own property, and I sign papers that I don't really understand, but I own property, and real estate is a good investment. Until in 2007, up here, the market had gone up 106%. Then when we turned on the news one morning, we found out that a lot of this real estate was tied into mortgages that maybe weren't as highly rated. And so fear went in again, and the market dropped all the way down 57% in 2008. So think about it. That's like if you have, let's say, your 401k at work, and at first it went up, and let's say it went up to $500,000, and then it dropped down 50%, right? So it's back down $250,000, and it goes up again to that $500,000 mark, and then down it slams again. This is what gets people, is the up and down of the market. And then you'll see from 2008 until February of 2020, the market took off like crazy. But here's the thing I want you to notice. When the market went down in 2000 and in 2008, notice this to the left, 1500, that's about where the market was. And in both those points where it was at 1500, it dropped 50% on average. And if you look at the market where it is, that's why so many predictions were out there that the market was going to be going down like crazy. Now, you can say, okay, so the market's come up some. Yeah, but again, what's making it come up? It's overinflated. I mean, look at the news. Nothing has gotten fixed. And so one of the things that we try to tell people is this up and down of the roller coaster. You know, don't let somebody tell you that it doesn't matter. Don't let a broker or somebody tell you, oh, it's only on paper. This is real money. It's real money. And especially when you're working and you think, oh, I've got a paycheck coming in. But remember, the idea is this is going to be where some of your retirement money comes in. We want you to be able to go from paychecks to playchecks, which paychecks are when you're working every day, you get paid. But playchecks are when you're not working, but you still have money that's being generated. So we want to make sure that that happens. And here's the challenge in the market. The market goes up and down, as we've said, but you've got the bull and the bear. So the bull is when the market's going up. So you remember that just because there's bull horns going up, right? That's your visual. And the bear is when the market goes down, and that's what hurts. And so what we look at is there a way, or how hurtful is it when that happens? And is there a way to avoid that? Well, first, let's look at how hurtful it is when our market goes down. This is one of the reasons why we tell people, don't just say, okay, it's okay if the market goes down. Look at this chart here. On the left-hand side, you'll see if the market goes down 50%. And again, it did that in 2000 and 2008. Well, that means you don't need 50% to get back. You need 100% to get back to where you were. So let me give you an example. Let's say you have an account with $100,000 in it. If $100,000 goes down 50%, that gets you to what? Hopefully you're saying $50,000, right? Then if it grows, because sometimes people think, oh, I just need 50% to get back. Well, if that 50,000 grows 50%, that takes you to 75,000 only. So you're not back to where you are. You got to go all the way back 100% just to get back to where you were. And if you'll look just to the right, it says that takes on average 7.3 years just to get back to where you were. So if you've got somebody or you think that, okay, it's only on paper, doesn't matter. Well, think about it this way. Let's say that you're still working and you got an employer that calls you in on Monday morning and he says to you, hey, listen, you're doing a great job. And we want you to do a great job, but we're going to make some changes around here. Here's the thing. We want you to come in for the next 7.3 years, do the same job, but we're not going to pay you. And hopefully you would think there's something wrong with that. And maybe I'm hoping you wouldn't stay at that job very long. And I use that example. You might say, well, duh. But here's the duh in it for me. Why would you want your money not working for you? If you're working with someone or you believe that your money's okay not to be doing anything for 7.3 years, then that doesn't work. Money needs to be working for you, because the idea is at some point in your life, you're going to quit working, and you want to avoid all these drops and the emotion of it as well. So let's talk about one of the different ways that you can try to avoid and manage some of the risk, and let's get away from some of these areas that maybe aren't as enjoyable for you in life. So the first strategy that we want to talk about is tactical management. Now, you might say to yourself, tactical, what is that? So don't feel bad. I will tell you that I was in the business for 26 years before I ever heard about tactical. I had a good friend of mine that we were at an annual economic meeting together. Him and I were grabbing lunch, and he sat down, and he starts talking to me. He says, Bill, what do you know about tactical? And I looked at him and I said, what I did in the Marine Corps? And he looked at me and says, no, not that kind of tactical management. And I said, well, I don't know. I've never heard of it. What do you mean? And he said, Bill, I know you only work with people that are in a conservative time of life. He knows my father's story, and he knows that I only want to work with people when they're in that point of life where they say, I don't want to have to go back to work. Well, a big reason sometimes people would have to go back to work is if their retirement accounts go down 30, 40, 50%. And he said to me, he goes, you need to learn about this because it will help out your clients to help them navigate when the market goes down and avoiding that, number one. And it'll also help improve your experience with clients because, listen, when the market was going down like crazy, who do you normally turn to because you think that your advisor should know these things? Well, sometimes that would be me getting those bad phone calls. So this is just a different way of management. But again, don't feel bad that you haven't heard about it. Again, this is why we're doing these webinars to introduce you to these. So here's what tactical looks for. The biggest difference is it looks for more consistent returns with less volatility. Again, more consistent returns with less volatility, meaning less risk. So let me talk to you about the two different types of returns that are out there. You have relative return, which is what most of you are used to, what you've been experiencing in your 401ks and your brokerage accounts, or consistent return. So three main differences in those two. Relative return just says, hey, we're going to define success as comparing it to a benchmark, like that S&P 500 index. So we're going to compare it to it. We want it to beat it, and even if that means it can go down a lot. As long as we're beating that S&P 500, we're okay, even with all the negative years. A consistent return, on the other hand, the type that is tactical, says, no. We want to have consistent returns, not up and down, up and down, up and down type of return, right? The other thing is, with a relative type of return, again, what you're used to in most of your 401s and retirement plans and your brokerage accounts, they're not really concerned about the risk. They kind of tell you, oh, that's just part of it, don't worry about it, so on and so forth. But consistent returns say, no, we want less volatility. We don't want the market risk, or we want to minimize that and be a lot more defensive than just letting it drop and saying that's okay. And then the third component that's the big difference is with a relative return, again, the type that you're more than likely used to. Those are based on the design of those institutions that are holding your money, of what's best for them, what they feel is best for the company, and then they fit clients into that box. And if you'll notice, if you have some big box name brokerage accounts, and I'm not going to name any, but if you have a particular company, then they probably have a bunch of their funds inside of there with the same name. Well, guess what? That's what's the most profitable for them. But the difference is, with a tactical, which is a more consistent return, their designs are based on the needs of the individual account holders. So there's no cookie cutter component where everybody has to get into this particular investment type. It's based on individual needs. It's more of a boutique selection, if you will, of what does that person need at this stage of your life. Not just, okay, let's put everything in one type of fund or one group of funds, because that's just what we do. Hopefully that makes sense, because again, that makes a big, big difference, and you want to make sure that you're focusing on some of these things. So what does the design of that look like? Well, the first component, and it's important, is they try to sidestep when risk comes. Because a lot of times diversification isn't enough. You know, I have some people that say to me, well, my advisor told me I'm well diversified, so if the market goes down, I'll be okay. Well, here's what diversification means. When the market goes down, instead of 1 or 2 investments going down, diversification means you got like 40 investments or whatever it is going down. That doesn't keep them from going down. But when you say I'm going to sidestep it, think about like a car is barreling towards you. And you're saying, well, I can either stand here and take the hit, or I can get out of the way. And that's what tactical does. It says, okay, sometimes you just got to get out of the market, get out of the way. Think about 9/11. When that happened, we knew, anyone knew, the market was going to be terrible for a long time. Why? Because it was the first time since Pearl Harbor on American soil that we've been attacked. And so your traditional type of portfolios you've got just says, okay, write it out. Well, tactical said, no, write it out. This is going to be terrible. Let's get out for a little bit, or let's go to something less volatile. That's the first component. Second component is we're going to have a system with mechanical indicators to eliminate the emotion. That we don't want to try to sit here and say, oh, well, we think things are going to get better. Just take the emotion out of it. Now, most of you know the name Warren Buffett, and most of you will agree he is the #1 authority when it comes to the market. Many, many times they've interviewed Mr. Buffett, and they've said, Mr. Buffett, if we could get one quick thing to help us do better in the market, what would that one thing be? And he always looked and he says, oh, that's easy. Take the emotion out of it. Take the emotion out of it, because people buy at the wrong time and they sell at the wrong time. So that's a big thing that, you know, maybe we need to listen to Mr. Buffett. And here's why. On this chart here, this is the 20-year average of these different sectors and how their returns have been. So you see that little orange block all the way to the right. That's the average investors. So for a lot of you in the crowd, or maybe even your brokers, how their returns have been, 1.9%. Wow, that's not very good. Well, and again, this is a study where they looked and they said, okay, the average investor, and why is it? Because they bought and sold at the wrong time. They've let emotions get the best of them. And we're all emotional. I mean, it'd be nice if we could take the emotions out of it, but for most people, they can't. And they kick themselves in the hindquarters when they haven't been able to do things at the right time. But it's, again, you can't take the emotions out of life. Think about it again. When houses were going up so much in price and we knew they were overpriced, but people kept doing it. Why did they keep doing it? Because of greed. And then what happened at the wrong time was maybe then they sold out of fear. So we want to make sure that we get the emotion out of it, because that block just to the left, that's called inflation. And inflation is just the cost of what the average stuff that you buy to live on, milk, bread, things of that nature, how much those go up every year? Well, they go up about 2.2% over a 20-year period. So people's investments, that the average investor, they're not even keeping up with inflation. So that's, you know, that's not good. And when we need to improve on that. So don't feel bad if you haven't done well in the market. Again, the average investor only 1.9. So here's the difference between the type of investment styles. Passive and strategic is what you're used to. That's what's in your 401 and all these other types of brokerage accounts versus tactical. Let's first talk about the passive and strategic, what that means. What that means is they're going to tell you to buy and hold. Just hang out. Just don't, if the market's going down, don't worry about it. It'll come back, so on and so forth. They believe that buy and hold is good no matter what's going on. And again, the example I used earlier on 9/11, you know, we knew the market was going to be terrible for a long time. Why? Because we knew we were going to war. And war always brings fear, uncertainty. And so rather than, you know, maybe making some decisions and getting out of the market, no, they just write it out. Don't make any changes. In fact, if you're working with someone or you're doing it on your own, whenever you call some of these brokerage companies and you tell them, hey, should I get out of the market? They'll tell you, no, why? Don't get out of the market. And the reason for that is, unfortunately, because most of their compensation is built when your money's at risk. And there's times when your risk shouldn't be there. It should be out of risk, right? But unfortunately, that's what they believe. Just stay there, stay there, stay there. So let's talk about tactical. Now, the word tactical, it's a sailboat maneuver that if you've ever sailed, you know. This means when you're going to turn your bow or the front of the boat into the wind, and you're going to go into the wind, it's a way for you, when the wind gets rough, to get to the direction you need to. But here's the reality when it comes to, if you've ever been out on a boat, when a storm comes, when a really bad storm comes, the first thing you've got to do is drop your sail so you don't capsize. I mean, you maybe have seen this in some movies. It's scary when you're out there and you think, you know, even no matter what size boat it is, the ocean is huge. And if you don't drop your sails, you're going to capsize and, you know, then you're really in trouble. Well, that's basically what happens with tactical, is at times you need to drop the sail, meaning get out of the market, sidestep it as we talked about, because it's just going to be bad for a while. So let's just ride it out, but let's drop the sail so we don't capsize your financial boat, if you will. And hopefully that makes sense for you. So let's take a look at one of the accounts, one of the tactical funds, and see how did that compare to how the market did during the period from 2000 to 2018. Now, here's the thing. I have to tell you up front, past performance is not an indicator of future performance. You probably have heard that a million times, but I can look back at real numbers and say, okay, what happened? Because as an advisor, this is what I look at and what I looked at when I first looked at tactical. So all this shows you is two different lines. So you'll see the dark line here in the bottom, that's the S&P 500, and then you'll see the orange line on the top. But notice if you go back here to the year 2000, both of these accounts started out with about, let's say that's 100,000 in the account. And you'll see that for 2001, 2002 to 2003, they were both about the same. So here's the thing. I don't want to paint some glowing picture for you that these are magical things that can occur with these accounts. They're going to do relatively about the same when the market is doing well. Not when it's crazy high like it is, but when the market is relative and it's normal, they're going to do about the same. But you'll notice in this red box here, look at the difference. You'll see that in 2008, and we know that now, the market itself, which again is a dark line, it went down. And it went down and stayed down for a little bit. But notice what happened on the orange line, the tactical. Notice it didn't go down. It stayed even. Well, that's because they're actively, not passively, they're actively managing it. You don't have to. They're doing it for you based on computer algorithms and a bunch of other things that are technical, but they're doing it for you. And you'll notice the difference is you're going to get a pretty big separation here over time. And like I said, you know, these things are technical on their end, but when you look at that graph and you say, okay, and this is just one of the tactical funds, but you look at the difference between 2008, 2010, that's substantial. Well, you know, let's look at this graph here, which is the same thing, but we want to highlight the difference in 2008, 2009, 2010 in performance. So again, the top fund is a tactical. You see the red box there, and then the S&P 500, the market itself. is down here in the bottom. And in 2008, you'll see here that the market itself did almost 37% negative, meaning it went down 37%. But look at the tactical. It went up 5.5%. So you may be saying to yourself, wait a minute, the market went down, but the tactical went up? Yes. Tactical, they're actively managing it. So not only can they maybe go to cash or bonds, but they can also do what's called shorting the market. So that's a technical term. All it means is they can potentially make money when the market goes down. And in this case, they did. So in 2008, the tactical did really well comparatively to what people were experiencing their losses that weren't in tactical. 2009, the average person in the market, they recovered some, 26% positive, but look at the tactical. It had a 37% increase that year. So not only can it do good when a market is defensive, but also during opportunistic, when the market is within normal conditions, they can do well. And then look at 2010. 2010, the average person in the S&P 500 index had a gain of about 15%. Again, a pretty good year after having a 26% year. But look at what the tactical did. Over 46%. Over 46%. Same strategy. So I'm not picking different strategies and just highlighting those. It's the same strategy that they started out with. And then let's look at the end result of what that was, because this is important. You're putting your money somewhere, you want it to grow for you, because this is money you've worked hard for. So again, as a reminder, the first circle here is both accounts started out with the same amount of money, about 100,000. And then if you'll track what the S&P 500 index did, which is again what the average person in the market did, it ended up, let's say that's about $250,000 in 2018, 18 years later. So you might say, well, 100,000 invested for 18 years, grew to $250,000. That's not bad. But take a look at what the tactical did way up here. Way up here, and I'm going to say this value is somewhere, that's the 2 million mark. That's about $2.4 million for the same money. $2.4 million versus about $250,000. And if you look down here into this red box that says inception, all this means is from the time that this graph started until now, 2018 on this graph, where were they? Well, the S&P 500, again, the bottom one, was at 5% return, so that's not bad. But the tactical had an over 19% return. Wow. That's pretty significant. I hope you'll agree. I hope it makes sense for you, that major difference. This is where you're starting to understand why I thought tactical was awesome as an advisor, because I'm trying to help my clients. And one of the first accounts that I moved was mine and my wife's. Why? Because I, like you, work hard for my money, and I want to make sure that I don't have to keep going backwards and in my own personal accounts as well as my clients' accounts. Now, here's the thing. And again, there's some technical parts of it. You know, the whole idea here is not for you to understand the technical part. Sometimes people want to understand the technical of everything. Understand the basics of it. It's kind of like how I have a car that I enjoy driving. And, you know, back years ago, I used to be able to work on cars before all the computers got it to where you couldn't. But I've got a car, I enjoy driving it, and all I want it to do is take me from point A to point B. And I know how to put gas in it and oil in it. I know how to check the air in the tires, put air in the tires so that it takes me from point A to point B. But once in a while, it breaks down. And now here's the thing. When it does that, I don't know enough about it. And it's not that I couldn't be a mechanic, but that's just not where I've spent my time. So when it breaks down, I take it to a mechanic that they have all the credentials, all the expertise, and they get it back working again, because all I want them to do is get it fixed so I can start driving it again. So the biggest thing I'll share with you is don't get overly technical with these things. Keep these things, again, simple, so that you understand what is it you want to do, and do these things allow you to do that. So here's one of the things that most people aren't aware of. There's an act called the Dodd-Frank Act. And the Dodd-Frank Act requires financial institutions with $10 billion or more to do what's called an annual stress test. And here's all that is without getting too complicated. All it does is it looks at where does that financial institution have their money invested. And then it says, okay, if a financial crisis arises, how will your institution and its portfolio, how will it react? How will it do if that were to occur? So that's what we help clients with, is doing a financial stress test with them. And let me just show you what that looks like as an example. So in this example, you'll see, and this isn't technical, you've got two different portfolios. So on the top, you've got the current portfolio that this person has, and then we show them compare it to the tactical portfolio. Now, the tactical portfolio that we show them is one based on how much risk after they take a risk test, which is critical because it needs to be what's on right for you on your risk. But how much risk should they have? And that's the tactical that we compare it with. And so you'll see here, the first thing is the first measurement. This says how much risk does the portfolio you have now have? And that's a numerical rating that all portfolios have. And this says, well, they had a risk score of 71, and the tactical that we showed them only had a risk score of 20. So it was a lot less risky, right? Number one. Number two, it looks at how much drawdown, meaning max drawdown, does this portfolio they have compared to the tactical. Max drawdown just means at any period of time, how far, what was the maximum it came down? Hopefully that makes sense. So their portfolio came down about 50% during the worst period of time, and the tactical, well, it came down about 8%. Okay, well, that's a big difference. And then hit this one here, the green, just says, okay, what's the average return that your portfolios had over that period of time? They had about 9%. The tactical had about 11. And then the last component that they do is the percentage total return. Well, their account had a total percentage return of about 290%. Now that sounds great, but look at the tactical, 423%. Huge. So let's then look at the individual graphs of the comparisons. So this is that max drawdown that I shared with you. Now their portfolio is the green line, and you'll notice it comes down 50% or thereabout when the market had its financial crisis. Again, all we're trying to do is to stress it, to say, okay, how did that react, or how should it react? Because the reality of it is we don't know how it's going to react, but we can go back and look at real numbers and say, how did that react compared to the tactical? Well, if you look at the tactical, which is the blue line, wow, that only came down, I'm going to call that about 8% or a little over 8%. Major difference. Remember, what we're trying to do is get a consistent return and not have the emotions built into it and the account balance is going up and down, crazy amounts. Now, here's the reality of it. Then the last part of the stress test is we just show people, and if you look at the middle line here, well, we're going to take the worst year that there's been, 2008, January to December 2008. The average person in the market lost 37% in equities. But look at the tactical. It only went down 2.9%. And that's what we're trying to do, is make it that it's not that it won't go down at all, but we want to make sure that, okay, this isn't something that, can you imagine your accounts, and I've had a lot of you talking to me lately, where over the last few months, your accounts have gone down 30, 40% because you didn't have something that was tactical or safer. And I've had a lot of people saying to me, man, I'm not sleeping good. And so again, we want to get it to where you're sleeping really good at night. And these kind of plans basically just say, okay, you're going to have these kind of occurrences happen. Again, it's kind of like living in Florida. We have hurricanes. So why not prepare for them? Wouldn't you rather have something that doesn't have the potential to come down 37%, and instead it only comes down maybe 2 or 3%, if that? So that's the tactical. And the big thing that we try to emphasize to people is doing the stress test, because it makes a big difference for you. And it opens your eyes just like mine were open when I first looked at tactical. Okay, I'm hoping that made sense. I hope I kept that really simple for you, because again, I don't like to get technical, but that is on the tactical. All right, so let's talk about the second strategy for managing your risk in 2020. And again, I want to keep this really simple. A lot of what we've had were questions from people of, okay, what's an alternative to bonds? Because bonds, since interest rates are so low, and they've been low for 11 years, they don't seem to be really giving a good return anymore. And that's really the only thing that somebody thinks maybe their advisor has told them makes sense, because maybe it's a little bit safer than equities. Well, let's just talk about why maybe there's some reasons to look at some alternatives to bonds as well. Besides just income, bonds can also lose value. I mean, it's happened, and it's happening. And the reason being is because the only difference between bonds and equities is equities, meaning stocks and things of that nature, they move faster. Bonds just move slower, but they can lose value or default, which means there's no value coming out of them at times. So we want to look at that, and we want to say, are there some options maybe than to bonds, because bonds don't seem to be giving the same predictability and the same consistent returns. So economist Roger Ibbotson, he's very well known. You may have seen him on some shows on TV. He talks about stocks, bonds, all kinds of different things, inflation. And he recently came out and said, you know, he believes that fixed indexed annuities, that they have the potential to outperform bonds and this is important, give a smoother return, a more consistent return. They also have downside protection because they're principally protected. So now, before some of you maybe turn off your ears because maybe you've heard things about annuities, positives or negatives, just do me a favor, keep your minds and your ears open, because we have lots of people over the years that come in and they say, I've heard things about annuities, and when we end up talking to them, it educates them a little bit as far as where they are. Now, again, Roger has no axe to grind. He's just trying to inform people, and that's what we're trying to do. So let's look at some of the alternatives, or what an annuity actually is or isn't. And remember, there's all kinds of different types of annuities, but let's look at this specific type of an annuity. So this type of an annuity basically is like your Social Security, where it's a payment every month. So no matter what's going on, you get that. And it's also a pension. So I have people a lot of times, hopefully, you know, if you're lucky enough to have a pension, I ask people all the time, what do you like about pensions? And, you know, they usually say, well, oh, I love the fact that it has a monthly check comes to me no matter what, so I know I'm going to be okay. Well, guess what? Every pension in the United States is an annuity contract. It's not the risky type that maybe you've heard some bad things about. We don't do those. It's the principal protected type of annuities that all it says is we're going to create a private personal pension. That's it. So again, all you're looking for with this kind of an annuity is to say, look, I want guaranteed lifetime payments, or what we have coined as play checks. Again, paychecks are while you're working, and because you go to work and they have your calendar and they take your time, they pay you. Play checks are where nobody owns your calendar anymore, but now you've got these checks coming in every month, just like a personal pension. Now, the market going down can't decrease them. You know, if you happen to pass away early and there's any money that's left in the account, the insurance company doesn't keep it. It goes to your beneficiaries, probate free, which is an awesome feature as well. And so, you know, it is an option for you to consider. Now, you know, going back to my dad's story with his plan, what he was most concerned about is, like most people are, running out of money. Do I have enough? And my dad, even though my dad was a paratrooper during the Korean War, in fact, he trained people at Fort Benning. He was a training cadre, which means he jumped out of the plane so many times, he lost count. So he never has had a physical fear in his life. But when my father retired at 70, I could see he was a little uneasy. And even though his son had said to him, Dad, you're going to be okay. I'm an advisor. I'm your advisor. And I'm telling you financially, you're going to be okay. He really was uncomfortable till about the third month, when he called me up and he says, you know, I want to talk to you about my money because my checking account hasn't really gone down in the last 3 months. And I said, well, yeah, Dad, that's because it's not supposed to. That's how we set up your plan. And he said, yeah, but where's the money coming from? And I said, well, remember, Dad, when we put your plan together for retirement, all we simply did is we figured out how much money did you and Mom need to live and enjoy life. And then we minus your Social Security from that. And that left us with an amount that you needed monthly going into your checking account. And so let's just say that was $500 a month. And I said to my dad, do you remember that? He says, yeah. I said, well, look at your checking account statement. Do you see about the 15th of every month, you've got a check for $500 going into your account? And he says, oh, okay. He said, well, how long does that last? And I said, it lasts as long as you do. And that's when my dad finally got comfortable, because he saw that the checking account that he was paying his bills out of stayed about the same, just like when he was working. So again, it's just what an annuity does. It's there. It has a specific, definite reason. You know, people can tell you pluses or minus, but that's how they work. Let me give you a visual of what an income plan might look like. So on this example, and again, the numbers are different for everyone based on their age, the amounts of money, but all I wanted to do is show you. Here's how we create and can create a private pension. So in this, they've got $250,000 and they say, all right, if I turned it on year one, because I'm planning on retiring in a year, how much would it give me? And in this case, it gave them $14,000. But that $14,000 would be guaranteed for the rest of their life. They can't outlive it, whether they live till they're 90, 100, or whatever age, because the insurance company is taking the risk, just like with your pension. So it's a private pension. Now, let's just say that they're not going to retire for 5 years. Then it increases, because like with a pension, the longer you wait, the higher the guaranteed amount is. And again, if they waited till 10, it would go up to about $26,000. Now, you don't have to decide now when you want to turn it on. You can decide that later on, because your plan also needs to be flexible enough that you can make changes, or maybe just quit working when you want, or whatever, and that you're not tied into something that you don't have flexibility. So your plan needs to be flexible, but you can see from some of these numbers, wow, okay, these are some guaranteed amounts, and you just absolutely can't outlive them. So that is what a lot of you have said to me, that, look, I want a predictable plan that's going to give me money. Sometimes people will put several annuities together and have one turn on year one on 5, whatever. It's different for everyone, but we do have people that they don't have annuities. They don't need those. So please understand that that's not something that's a requirement. It's just an additional tool that we have in a toolbox to help people build their financial plan. So again, they have their financial GPS to get them to the retirement in a simple, predictable way that they're used to. So I hope that helps you make sense and helps you understand this type of annuity, because remember, there are some out there that I agree they're not good for, to me, retirement plans, but this just gives you some idea of that how they can be used in your benefit as an alternative to bonds for income. Hopefully that makes sense for you, because again, I want to keep this really simple. So let's just talk about and wind this down a little bit about the basics of, you know, what is it we're trying to do? Number one, a lot of you know what this is. This is Mount Everest. And you might be saying to yourself, okay, Bill, where are you going with this? Well, again, an analogy. I want to help you understand. You know, last year in the news, we saw there were a lot of people that were climbing Mount Everest. In fact, it was getting very, very busy. There's about 18 different paths to get you to the top. Now, me personally, being a South Florida guy, I'm never going to do that. I will just tell you, cold weather and me, we don't get along well. But there are people that want to do this journey and go all the way up. They're going to risk their lives. They have to prepare for it. It takes a long time to get prepared for it. It takes about 40 days, just because your body, from the time you start, you need to get used to it. And let me just say something. Sometimes people think, like this trip up to Mount Everest, that retirement is impossible. Seems like every time they get somewhere, they get a little bit higher, they get knocked back down, maybe by the market or something else coming along. So here's what I want. I want to encourage you. Don't miss getting to the top of your Mount Everest or to your retirement goal. I got to believe that if you got up to the top of Mount Everest, the view has got to be fascinating. It's got to be unbelievable. Same thing with retirement. And let me tell you, I get the privilege of helping people get to the retirement destination. And once they get there, the number one thing I hear from people is, wow, I wish I would have gotten there sooner. I wish I would have retired sooner had I known it was going to be this awesome. And so I try to help people retire even sooner, because I know once they get there, they're going to be like a kid in Disneyland for the first time. They're going to be unbelievably happy. Nobody's telling them what to do. Imagine being on a permanent vacation. But here's the reality of it. There's lots of different paths to get to your retirement destination, just like there is to get to the top of Mount Everest. You have to determine those paths. That's the same thing as there's a lot of different ways for you to use different vehicles to get to your retirement destination. And maybe you've worked on some of those paths or some of those ways that they don't work. And I'm hoping that you're going to see that these are some paths that will help you with a more predictable, dependable fashion for you to be able to get to the place that you want to get to, which is retirement. I mean, look, the reality of it is we don't know how long we're going to stay retired, right? I'm sure you've had friends like I have that they were retired for just a short time, and then unfortunately they passed away. They never got to be able to enjoy it. So the big thing I tell people is get retired as soon as you can. Those are what's called your go-go years, when you're healthy enough to go and do the things that your body lets you do. Because the next few years are going to be your slow-go years where you're just not able to do them. And then your last few years are going to be your no-go years. And I try to encourage people, go, go, go while you can. And that means spending more money now while you're healthy. Get on those trips and enjoy things. So how are you going to get that done? Well, let me encourage you this. Get a second opinion. Get a second opinion, please. Why do I say that? Because it's just like your health. You know, if you went into the doctor and the doctor said to you, hey, there's an illness that you have and there's a treatment that you should do, or there's no hope for you and you're just going to be dealing with this. I hope, like me, you would then say to your doctor, okay, great, doc, thank you for your opinion, but I got to go see if there's a specialist that can help me. Now, it's not that you don't like that particular doctor, but the doctor, just like some of you are dealing with one advisor or doing it yourself, and you only know, or they only know what they know. Kind of like how I only knew about the type of management we did before I learned about tactical about 5.5 years ago. Now that I know about it, what we do are second opinions for people to say, okay, is there something that you're not aware of that can help you out? And if there is, great. Then we can help you fix these things. And the way that that looks is we then set where we get you the complimentary stress test. Remember the stress test that I showed you in the beginning where it just says, okay, just like what companies with 10 million or 10 billion or more in assets, their stress test they have to do, that's what we do. We just say, okay, with what you got now, with what you're in, how would that happen or how would that perform compared to tactical? That was the first thing that opened my eyes and made me realize that I needed to do tactical for me as well as my clients. So the first thing we do is we do that stress test complimentary. There's no cost or obligation on that. Then we do your digital, or if you want to come into the office, which we have everything here sanitized, we have masks, gloves, the whole 9 yards so that you're safe. If you want to come in for that meeting, you can, but we also do them digital, whatever you're comfortable with. So we can show you and go over that stress test so that it makes sense to you. Because again, it's about keeping things simple. And then there's no cost for that. The only thing that we tell people to do, we tell you, we're not making any decisions, either you or us during that meeting. The only thing we're going to decide is, are we going to get together again? If we get together again, then we're going to design a plan that does a couple of different things. Number one, reduces your volatility, which means the amount of market risk. Because again, risk isn't good for retirement plans. I think you've seen how you don't really need it. Then the other part of the plan is we're going to show you how to have a more consistent return on your portfolio, not the ups and downs that too many people are used to. And then the last thing that we're going to do is talk about an income plan for life, one that instead of your money controlling you, you're controlling your money. And you know, the reality of it is there's a lot of different things that can happen in your life regarding your finances. You know, when we do the classes, we try to encourage people not only to address the finances, although that's what we specifically talked about today, is how to make sure that your money doesn't disappear on you or keep going up and down. Your money is the fuel to get you to your retirement. Money isn't everything. Trust me. There's some people out there, I'm sure you've run into, that they think money is everything. It's not. But it is important if you're able to maintain your independence, enjoy your retirement, bless others, bless some charities around you, and enjoy what took you all these years of working. But I want to encourage you, the number one thing that keeps people from getting a plan in place is you have a stack of good intentions, just like I do, that you have all these things that you want to get done, want to get done, want to get done. But the number one challenge for people is actually taking the first step and getting some of these things done. So we want to help you with that. Number one, if you'll email us at info@assetgroup.us, then we want to get you set up for that first meeting so that, again, there's no obligation, no cost. When you meet with us, we'll tell you, even if there's a plan, we're going to present the plan to you and there's not a cost. We will at that meeting tell you if there's a cost, and then you decide if you want to do it. Here's the reality of it. While I could charge an hourly fee or a flat fee, I believe that I don't want anything keeping you from doing what you need to do and get to that first meeting. And that if what we're showing you isn't right for you, we're not going to charge you for our time. And I know there's advisors out there that do. We don't do that. God has blessed me over the last 31 plus years with a business that has done really well by doing right by people. In fact, that's our motto: do right by people, always. But to help you get to that first step where you just simply set up that meeting, we've got a great report here on Social Security, the truth about when you should file for it. It's a great page report here that we usually use in our college courses. So email us. The first 10 people that are emailing us, we're going to get you this report right away. It has a lot of value. Share it with friends, but also share this webinar with friends. If you've got people that you think need to attend this webinar because they're dealing with the same thing, they're in these investments or they have all this anxiety and stuff, please let them know about us, because we're going to be doing the webinars, or we can send them the recording. Now, so if you'll email us again at info@assetgroup.us, we'll get that to you. A couple of questions did come in. I just want to, again, thank you for getting those to us. A couple of things. Again, one question again is, are there fees for the meetings? No, there's not. And again, we'll explain that to you either by digital meetings or when you come in. The other things is what exactly, what type of planning, how long do they take? Most of these meetings only take about an hour. We get you a list of things that you should have ready for the meeting so that it's as productive as possible. One of the things that we get you is a 2-page questionnaire, just so that you can get that to us 48 hours before the meeting or the digital meeting. And the reason is because I want to make sure if there's something that's on there that is not clear, we get with you before that meeting to make sure that when we're spending that hour talking with you, we're more focused on what you're trying to do at this stage of your life, your concerns, your passions, everything you've got going on in life, instead of focusing on just the numbers. Because it's really not about the numbers. It's more about you and what you want to do. So I hope this has been a great webinar for you. I know I enjoy doing the classes. I love being around people and being able to touch them and be around them. But for now, these are, the world that we live in. We're doing webinars. If you've got any questions, please email me. God bless you, and please stay safe and happy. Thank you.